Hey everyone, Douglas here. Welcome back to the MMT Macro Trader. This market recap. It's Thursday, September 14th, 2023. We need to talk about a potential storm brewing. It's inflation, baby. We have now seen back-to-back months of inflation, CPI, at least year over year, the CPI reading come in higher than the month prior. This month in particular, the reading for August, which was reported yesterday on Wednesday, came in hotter than expected. In fact, the entirety of the inflation data effectively came in hotter than expected. Not to the extreme end, but hotter than expected across the board. And I had guessed as we headed into the final summer months here that two out of the next three, so the July print, the August print, and the September print, which we'll get in October, two out of those three will likely end up better than expected. We're going to start to see some surprises to the upside. The July print that came out last month in August was not better than expected, but we did see finally some better than expected or hotter than expected data on the inflation side, and I think that we're going to continue to see that take place here. And effectively, tonight's video is going to lay out why I think that's going to be the case, why I think we could be heading into a bit of a storm here with inflation, where inflation might get out of hand probably as we go into 2024 and the months ahead. That's what we're going to try and lay out tonight. If you are new here, make sure you hit subscribe. Turn that notification bell on. We have some good things we're going to be bringing you soon, so you want to turn that notification bell on. And if you find this video particularly helpful, make sure you give it a thumbs up. So, all right, we're going to look at a handful of things. We're going to look at some data, some leading indicators, some leading data that usually drives the inflation. Also, we're going to look at some data, and we're going to tie this into what the Fed is doing with interest rates. So we have a handful of pieces that we need to put together here to really kind of tell the full picture, and it is going to involve a handful of data points that we need to just kind of lay out, and then we'll put the picture together, and we'll see how these all piece together. But what we need to do is kind of first put together the structure, the underlying, the underlying theory as to what really drives inflation higher. Now, there are a handful of things that can drive inflation higher. One of the primary ones is going to be the interest rate itself. When the Fed sets the policy rate, that policy rate will be a driver of inflation one way or another, whether it's disinflation or inflation increasing. And the reason for this is because when the interest rate is increased, we'll use the increase for an example. When the interest rate is increased, one of the things that's going to do is it's going to increase the cost of doing business. It increase the cost of credit, it increase the cost of the term structure of prices. Everything gets more expensive. In theory, if the next part didn't happen, that would be disinflationary, right? It would decrease demand, not enough money to go after now the higher prices. But it's simultaneously, the Fed, when it does that, is simultaneously adding additional interest income into the private sector. And certainly when you have a relatively high public debt to GDP ratio, that only kind of exacerbates the effect of the additional interest income heading into the private sector. So that is why, from an MMT perspective, we've always said that higher interest rates will likely lead to more inflation. They're not disinflationary. Now, if you're interested in getting a little bit more detail on that, I do have a thread that I put together back in June that went over this entire concept. If you go to my Twitter, which is link in the description below, and go to the pinned tweet, the very first tweet on my Twitter page, scroll on down, you will see pretty much everything that I've ever put together thread-wise in Twitter that is worth referencing from a research standpoint. And you can see the guide here that you want to scroll down on, why haven't rates caused a recession, and it goes over each step as to what rates are actually doing in the macro economy. So take a look at that if you want more detail. Again, you can find that on my Twitter page. So that's the first thing. Rate hikes increase the term structure of prices, and then they add additional interest income to support that higher term structure of prices. And then again, there's some other components in this cycle as well that you can check out. So we know that the Fed is driving inflation higher because of the higher interest rates. And if the theory itself doesn't exactly hit, right, you're not exactly buying the theory. The other thing too is I've done statistical analysis you can check out again on that pinned tweet. If you go up here to inflation, click the inflation tweet. You'll find this one where we've done causal analysis of higher interest rates with inflation. Again, it shows up that interest rates have a forecastability to where the Fed policy rate has a forecastability to inflation. You can see that here as well. So across the board, not only theoretically does it make sense from a framework perspective, but we also have the data to back it up. So we do know that the Fed is looking out at the macroeconomy, making the analysis that they do, and then when they set the policy rate higher, that is going to affect inflation one way or another. And when they raise rates, from what we can tell, that actually increases inflation, right? That's what the data shows. So then the next question is, okay, if the Fed hiking rates or lowering rates has some sort of causal input into the interest rate, well, what is the Fed looking at? And they'll tell you straight up what they're looking at, right? So in other words, the theory here is, well, if we can find out what the hell the Fed is looking at, or what the heck the Fed is looking at, right, to make their decision, then we can maybe understand what the Fed is going to do next based on whatever input factors the Fed has that they're going to make the determination on. So what do they look at? They actually tell you growth. They're going to look at growth. They're going to look at inflation itself, and they're going to look at employment. And what we can do is gather some data as proxies for that, some kind of real-time data as proxies for those three factors, and see where that's headed and try and make some sort of determination for where things might be going from here. First, number one, let's go ahead and look at growth. I'm actually going to pull up a chart here, switch over to the S&P, hide oil. We'll look at oil in just a second, but let's look at growth first. One of the main factors here is going to be the price of the S&P 500, a bit of a proxy for growth. And as you can see, when the S&P rises, for example, heading into the great financial crisis, you saw the Fed raise the policy rate. Obviously, during the ZIRP period, they kept things very, very low. Again, one of three main factors. Even though we had growth, the other factors were not where the Fed wanted it. But finally, we started to see growth and inflation. And then obviously when COVID hit, interest rates went to zero. We saw some massive growth, and we continued to see the Fed hike interest rates. So from a growth perspective, using the S&P as a proxy, we continue to see growth, and we have no reason to believe that the S&P is going to fall off in any substantial way in the immediate future. Or I'm sorry, in the long-term future. Immediately, actually, we might be hitting a bit of a soft spot here in the next September, October. But in the grand scheme of things, it is likely that we are going to continue in the push higher growth-wise. I can actually pull up the recent reading of the net deficit, the year-over-year net deficit, and we can continue to see a growth in that net deficit, even though things have slowed down slightly for August. Long term, we are far from the danger zone, which is turning into a real surplus year over year. We'd have to get below the zero line for that. So from a growth standpoint, we're still seeing growth here, and there's no reason to believe that this growth is going to suddenly reverse course in any meaningful way. So again, we expect growth to continue to push higher from here. The next thing we should take a look at is the employment data. And again, the employment data just showing all-around robustness here. If we look at total non-farm payrolls, I have year over year overlapped with the actual levels. And again, non-farm payrolls just continuing to push higher. And if we look at the year-over-year change, yeah, we've come down quite a lot, but we are far from the levels where the Fed feels confident to take the foot off the gas, so to speak. So from at least the job gains month over month that we continue to see on the non-farm payrolls, looking very, very strong. If we look at the unemployment rate, again, you can see the correlation with the Fed funds. I've inverted the employment rate so you can see the correlation here. Employment rate inverted, and again, we are at still, even with the unemployment rate a couple weeks ago coming up slightly higher, we are still at historically low levels of unemployment. So all in all, even though we're seeing a slight weakening on the employment side of things, still very, very strong. Fed quite unlikely to take the foot off the gas, given every other contributing factor, given growth, and then finally, given inflation. And then again, a good proxy for inflation is going to be oil. So let's go ahead and pull oil back up. We'll hide the S&P. And once again, you can see a relatively, not relatively strong, but certainly a correlation where the Fed is seeing inflation and raising interest rates because of that. Now, it's oil that I wanted to finish with because this is where I think things get dangerous. It's starting to look like oil is breaking out. We got above $90 on WTI today, and I think there is space for oil to continue to run. Why? Let's look at a tool that I use called comparative inventory. So here is the comparative inventory chart. What this is doing is it's taking the actual inventories, the stocks at Cushing, Oklahoma of WTI, and it's comparing the current inventory level relative to the 5-year average. So that is the comparative inventory line. It's effectively a supply side model. How much supply is actually there for oil? It is generally an inverse correlation to price. Again, you can see the relatively strong inverse correlation on the chart. When comparative inventory goes low, oil has the price to run high, and you can see this correlation over time. After the 2020 dip that we saw in oil, or 2020 negative spot that we saw in oil, and the strong push up in inventory because of the COVID pandemic, we've seen inventory levels completely reverse. And I have been for some time now kind of calling for a takeoff in oil because we've effectively had the space, had the capacity, given inventory for oil to get at a much higher level. My other, kind of macro theory is that eventually we would see the Saudis and kind of the oil price setters say, well, wait a second, the economy is doing better than expected. We have no reason not to be effectively price gouging here. Why aren't we trying to get the price of oil higher? And it seems like they are actively trying to do that. And that is, in fact, what we are seeing play out with oil. So if you just look at comparative inventory, where we are at right now relative to the last time we were at this level, say July of 2022, we had oil prices much, much higher. Even if you want to say, okay, well, let's see what that looked like before the Russian invasion, even then, we were starting to push higher at those levels. So, oil starting to push much higher. We've had the capacity to push much higher. It makes a lot of sense that we continue to see oil just take off here. I think over the next say year to 18 months, we could easily see oil get to what would be kind of the breaking point for the economy, which could be all the way up to $200 a barrel. And given where the fiscal spending is, given where the robustness is currently of the macroeconomy, that is kind of about my back of the envelope calculation for where I think this economy could sustain oil prices up to $200 a barrel, maybe even more. We could get that high. So at this point, we have some room to run. Let's bring this back full circle then. If this economy can handle $200 a barrel, right, and we know that the Fed is going to look at growth, we know the Fed is going to look at employment, and we know the Fed is going to look at inflation for their inputs to finally make that determination for where interest rates are going to be at. We know that interest rates are a causal factor to inflation itself. They feed into the inflation cycle. And I think you see the pieces coming together. I think we can start to see as oil pushes higher, as we continue to have relatively strong growth, as the additional interest income from the higher rates continues to flow into the macroeconomy. Each step of the way continues to support higher rates, higher inflation. Inflation getting higher supports higher rates. The cycle spirals higher, more additional interest income into the private sector, and we see the cycle play out. And that's exactly what I spelled out in the Twitter thread that I did quite a few months ago now, is there is this kind of this spiral higher cycle that will inevitably play out and is very consistent with the MMT framework. So that's where we're at. And that's why I think heading into the end of this year and heading into 2024, we could start to see inflation really get out of control here unless something major comes out of left field to really kind of be a disinflationary force. There are some things on the horizon. Maybe we get a government shutdown. Maybe we get some geopolitical escalation. Something out there could happen where we get a disinflationary push for the Fed to go ahead and drop rates back to zero or back lower. If that doesn't play out, though, we need to be concerned for inflation pushing higher here, because there is nothing that should stop this cycle from continuing to push prices higher from here. All right, that is all I have on inflation tonight. If you like what I'm doing here, you're an active trader, active investor, you want research analysis like this multiple times a week, check out my Patreon, patreon.com/MMT Macro Trader. Developed a lot of tools that are absolutely crushing this market and can really give you a better understanding of how markets can play out from that MMT lens. So again, check out the MMT Macro Trader Patreon, link in the description below. But that is all I have for tonight. So until next time, good trading, everyone, and we'll talk to you then. Bye-bye.